In the previous video, we went through the basic accounting equation or formula and gave examples of each of the terms in the equation mean. In this video, we will talk about the basic accounting equation from another point of view and what is known as the 5 elements of accounting. In this lesson, we will go through defining income and expenses, since we know what are assets, equity, and liabilities in the previous lesson. Let's define income. As I said earlier, in this training, we will define more key accounting terms as we move along, in simple terms. We are not even going to mention the official definition of income. Look it up in an official-looking accounting book if you so choose. So, let's define income in simple terms. Income is simply the event that results in money flowing into the business. Income is actually not the money itself. Money is a separate thing, an asset. One could think of income as the reason for the inflow of money or the actions that were done to cause the money to flow in. That is the income. This should become clearer as we go through the examples below. Some examples of income are sales, services rendered, such as an accountant's services, a doctor's services, a plumber's services, etc. Interest received, rent received. Each one of these things above represents some sort of event that occurs, like a sale being made, which results in money flowing into a business. Here are the most common forms of business income. 1. Sales. For many businesses, sales of goods are their main form of income. A business can either buy product at a low price and resell them at a higher price to customers, or they can actually make the goods and then sell them. A business that resells goods is known as a trading business, while a business that makes goods is known as a manufacturing business. 2. Services rendered. Not all businesses deal with products. Many of them simply provide a service. Examples of this range from labor-intensive work like construction, plumbing, and repairs to technology-oriented services like graphic design, call centers, marketing, and programming work. Legal services, medical practices, and bookkeeping services also come under this category, of course. I'm sure you can think of other examples. Since service businesses don't have to deal with product and product costs, accounting for them is generally a bit simpler. 3. Interest and investment income. Another common form of income, though not usually the primary form of income for a business, is interest and/or income from investments. A business can receive interest based on money they've invested in a savings account. The interest amount is calculated based on an annual interest rate and usually accumulates in the account on a monthly basis. A business can also invest in another company or financial instrument and earn a return from this as income from investments. 4. Rental income. Businesses that own commercial or residential properties and rent them out to other businesses and individuals will receive a rental income. This is normally invoiced and received on a monthly basis. Let's now define expenses. If we define income as the event that results in money flowing into the business, then how do you think we define expenses? Expenses are simply the events that result in money flowing out of the business. Examples of expenses: salaries and wages, telephone bill, water and electricity, insurance or repairs, for example, to machinery, motor vehicles, properties maintenance, etc. In summary, expenses are the opposite of income. Now it is time to look at the difference between income and expenses. In other words, the difference between the result in money flowing into and out of the business, which could be either profit or loss. Let's define profit and loss. Profit is the positive amount you are left with when your total income exceeds your total expenses. And a loss is the exact opposite of profit. So, a loss is simply the negative amount one is left with when expenses exceed income. In order to calculate profit, we take our income and deduct our expenses. Profit indicates that a business is producing and selling valuable products and services at prices that are greater than what it cost them. In certain situations, expenses can be greater than income. In this case, the business makes a loss. Profits and losses are always calculated and shown over a certain period of time. For example, 3 months, 6 months, or 1 year. Why is profit important? A person starts a business and invests his assets in the business so that the business will produce a profit for him. This reason or motivation for starting and running an organization with the objective of making a profit is called a profit motive. Other organizations, such as welfare and educational organizations, are non-profit organizations, i.e. they do not exist for the main reason that the owner makes a profit, but for other reasons such as benefiting the community or a group of people. So when we are looking at income, expenses, and profit, we are really only looking at your for-profit business. The amount of profit that a business makes indicates how well a business is performing. This is known as the financial performance of a business. The profit and financial performance of a business is arguably the most important indicator of how the business is doing for anyone concerned with the business, such as managers, investors, and anyone else. The profit and financial performance of a business are shown in a report called the income statement, also known as the profit and loss statement. The income statement is one component of the financial statements, which are the key financial reports of a business. Let's see how profits and losses impact the owner's equity in our next lessons. In our previous lesson, we learned that profit is calculated by taking income and subtracting expenses. As we know, there is a final step in the accounting cycle, which is the closing off of accounts or closing entries, which is done at the end of each year along with the production of the financial statements. This involves closing out temporary accounts, incomes and expenses, and transferring their balances through a profit account into the owner's equity account. When the business has a net profit, it can transfer some or all of that profit to a specific account called retained earnings, which is a component of the owner's equity account on the balance sheet. Once the net profit or loss has been transferred to the retained earnings account, it becomes a part of the owner's equity section on the balance sheet. This retained earnings account reflects the accumulated profit of the business since its inception, minus any dividends that have been paid out to shareholders. Remember, dividends represent a distribution of profits to the owners, which decrease the amount of profits and retained earnings. Therefore, dividends can also impact the owner's equity by reducing the amount of profits and retained earnings that are included in the owner's equity account. So this is the illustration of how profits and losses impact the owner's equity as shown on the screen. After calculating profit and loss, if the business makes a profit, this will always belong to the owner or owners. Therefore, this will result in an owner's equity increment. Remember, the owner and his share of the business is represented by owner's equity. So when a business makes a profit, this always means more owner's equity, the owner's share. In the same way, if a business makes a loss, this means less owner's equity. More expenses mean less profit, which means less for the owner's equity decreases. In summary, the 5 elements of the accounting equation are typically categorized into 2 groups, the balance sheet elements and the income statement elements. Group 1, the balance sheet elements, assets, liabilities, and owner's equity are the balance sheet elements. They are used to prepare the balance sheet, which is a statement that reports the company's financial position at a specific point in time. Group 2, income statement elements, revenue and expenses are the income statement elements. They are used to prepare an income statement, which is a statement that reports the company's financial performance over a period of time, such as a month or a year. Overall, the 5 elements of accounting provide a framework for organizing financial information and preparing financial statements that can be used by investors, creditors, and other stakeholders to evaluate the financial health and performance of a company. In the next lesson, we'll go over what a transaction is, as well as the 10 or so different types of transactions, and how they affect the basic accounting equation.